reversal of fortune again for your money.
It is a comeback day on Wall Street today.
Wall Street stages a furious rally, one day after a violent final hour fall. Hope on the street that Europe's darkest days are behind them.
The European markets are closing out nicely in the green.
But lingering fear that the Friday trade will trigger another wave of selling. These truly are the dog days of summer, with no sign that the heat on your money is about to break. This is a CNBC special report, live from global headquarters, Markets in Turmoil.
Good evening, everyone. Welcome. I'm Maria Bartiromo.
And I'm Bill Griffith. Another day, more volatility, but this time, at least, the market finished the way it started. We started with gains, and we finished that way today.
It really is. But what whiplash that we are getting, and all of you as well. Another day, another mood swing for your money today. A day of real joy today, Bill.
So far, following yesterday's extreme pain, we want to get you through this day and what it means. We'll be doing that over the next couple of hours. But first, a recap on this Thursday of yet another wild day, capping off a wild week. Here's Mary Thompson with a play-by-play of what happened today. Mary?
Well, Bill, stocks took off this morning and never looked back, or more importantly, never looked down, and yet another day of very heavy trading. On Wall Street, the bulls charge ahead as fears of a U.S. recession retreat for now.
What a wild one on Wall Street once again. This time it was buying that propelled the major industries.
And lots of buying at that. 7 billion shares trading hands at the big board, bringing the six-day total to 50 billion, the most since the dark days of September 2008. Thursday's 432-point gain in the Dow, recouping all but 96 points of Wednesday's 519-point decline, and marking the first time in history the Dow's gained or lost more than 400 points in 4 straight days. Led by a rebound in financials, the rally in the S&P saved it from tumbling into bear market territory. Its 51-point gain, the second largest this year, as was the Nasdaq's 111-point jump. The market's whipsaw action this week noted by the president.
Now, some of what we're facing today has to do with events beyond our control. And as we've seen, it's playing out in the stock market. Wild swings up and down. And it makes folks nervous.
Well, most folks, in a bullish sign, corporate executives are buying during this month's dips.
Market turmoil now keeping insiders on the sidelines. They are, in fact, buying on this pullback between August 3rd and August 9th. We've seen the most insiders buy since March 9th, 2009. And you know what happened then.
Stocks took off just as they did today, getting a jump in early trade as first-time unemployment claims fell below 400,000 for the first time in 4 months. Adding fuel to the rally, Cisco's better-than-expected earnings. Orders for the networking giant unexpectedly increasing. And investors welcoming news of a meeting next week between French and German officials to talk about improving economic governance in the Eurozone, raising hopes for some action on the region's debt crisis. Unlike past sessions, the Thursday flight smooth with little turbulence.
I'll tell you what I see. It's a little calmer today. You always got to be careful about making these pronouncements, but it looks fairly calm right now.
Reflecting this, the volatility index pulled back slightly, though this measure of fear remains at elevated levels. Convincing few, Thursday's rally is a sign the worst is behind us.
Cashin, is this a bottom in the market?
I'd like to believe so, but I think it's way too early to tell.
I think a lot of people would like to believe so. Tomorrow, of course, investors will have plenty of economic data to mull over. July's retail sales numbers, a first look at consumer confidence for the month of August, and June's wholesale inventories. Bill, we will be watching to see how this wild week closes out.
Yes, we will. Can't wait. Let's get you. Thank you, Mary Thompson, very much. Well, it's already Friday morning in Asia, the final day of the week there. Let's see how they're doing so far on the heels of our rally. And so far, you can see that the Nikkei, the South Korean Kospi, and the ASX 200 in Sydney all trading higher at this hour. As for our futures, still early, but we'll look at them anyway and see how they're doing at the moment before tomorrow morning's open. You can see some minus signs so far at this hour, but we'll keep an eye on that over the next couple of hours as well.
Let's get back to that wild ride on Wall Street today. Bob Pisani has been front and center for the action. And Bob, this week we're watching history in the making, no doubt about it. Never before have we had 4 straight days of 400-point moves up or down on the Dow. Could we finish the week a perfect 5 for 5?
Yes. Well, the answer is yes. As a market reporter, it doesn't get more exhilarating or more exciting than this. I could use it a little calmer, though, because it's hurting people's nerves down here. I've never seen such confusion. You know, the toughest part of the week is watching the specialists, the designated market makers, try to open their stocks. It's just been so nerve-wracking every single day. This morning I was watching one of the designated market specialists, the former designated market makers, try to open his stocks. He looked like his eyes were going to bulge out of his head. He was just trying so hard to figure out what's the right level to open them at, and where's it going to be 5 minutes from now, because they didn't really know. Most traders were messaging me this morning seeming a little bit more optimistic. There were attempts to buy the market a couple days ago, didn't work very well. One trader said today, it's taken nerves of steel, but I'm going to go long at this point. And I think that's the issue. Where do you find a bottom? What's the sign? What's the signal? So that's why corporate insider buying, as well as the higher levels of buybacks we've seen in the last few days, you saw mentioned in Mary's piece, that's really important. They really seized on those two ideas because they said, hey, if the corporations and the insiders are buying, that's as good a sign of a bottom as we're going to see anywhere.
Bob, how much of this volatility, though, is attributable to the computers that are doing some of the trading at this point as opposed to just the human beings?
Listen, 60% of the volume is machines at this point. And of course, you can argue those machines have an unfair advantage over people. But nonetheless, listen, one way or another, people program those machines, and those machines are buying here. I think the big question is, if people bullish or bearish right now? Most of the traders I talk to, Bill, are hopeful, but a majority of them are still kind of bearish. They don't think that Germany has the political will to go through with the changes they're going to have to make. They don't think that Europe is going to agree with the austerity measures. And they're very doubtful whether the U.S. has the political will to make all of the changes. I'd say the street is still very, very cautious.
I mean, it's clear that humans will still determine the direction of the market in the longer term. But in the short term, these market swings, these incredible wild swings, the precedent that was just set that Maria was mentioning, that's computer-driven, isn't it?
Well, no. Listen, if you want to go blaming the ups and downs on computer-driven trading, I think you're pointing in the wrong direction. I personally have no doubt that at extremes and high levels of volatility, the machines can exacerbate some of the price swings, but don't kid yourself. We went up for months on end through the end of last year into the beginning of this year. I didn't see anybody coming out and saying machines drove the markets higher every day. Thank you very much. I think in the bottom end, stocks will ultimately trade on multiples of earnings, and right now, nobody can decide what those earnings look like. For this week, they're clearly trading on fear.
All right. Thanks, Bob.
Okay.
See you in a little bit. Jim Paulson is Chief Investment Strategist at Wells Capital Management. He joins us now to try and help make sense of this manic market week. Lucky you. What has this been all about, in your view?
Well, I think it's mostly panic, Bill. You know, it's unfortunate that the S&P announced over the weekend, and then we had the first 3 days, we had a vacuum of any kind of fundamental reports at all. We had no real economic reports. We had no earnings reports. Today was really the first day we finally got to a fundamental report on something. We got the unemployment claims. We got Cisco earnings. And I think it's good to see maybe for the first day this week, prices sort of at least considering something fundamental that is starting to tie back into. Our problem earlier in the week is there was nothing, no fundamental news, so you're left to your worst nightmares, and you tend to then trade off rumors and innuendo, and a very emotional market panic is what we've been through most of the week.
Jim, was there anything that you saw today in the rally that might indicate that we have actually washed out and flushed much of the selling and we're close to a bottom, or not?
You know, Maria, I thought maybe we hit a crescendo last week, so I don't know. I think it's encouraging, I guess, you know, that we've now gone down, at least kind of had two tests of that 1100-ish level on the S&P 500. We've come back from both. It's interesting to me tonight that we are 25 points away from being unchanged in the stock market from where we were prior to the S&P downgrade last Friday. Bond yields, the 10-year yield, 6 basis points below where it was last Thursday. So we have recouped a lot, but we're still in very volatile mode.
Right.
I think ultimately this is going to be decided by what the news on timely reports like retail sales tomorrow, unemployment claims, those types of things. If they show in the next few weeks that we're not falling off a cliff, then I think we have reached, you know, somewhere close to our lows.
How much of this is also, let's face it, the stock market can be a barometer of the national mood. How much of that is what's going on as well right now?
Well, I think that's certainly part of it, Bill. I think we've been kind of building up to this with the fear generated by the debt ceiling debates and you know, wondering what S&P would do, and then we had the downward revisions of GDP. Sort of a, you can't point to any one thing, and the Europe situation keeps burning, but taken together, it's just escalated fears to the point to where we broke through technical support around 1250, and fear just took over. So I think it does reflect that, but you know, if a market could go down 50, 100 points, it sure can go up that fast again, too.
So what do you want to do then to position yourself best ahead of any possible rally down the road later on this year?
Well, I think that investors should, you know, stop thinking about what might happen tomorrow or next week and start thinking about where could this be 6 months from now. And I think that if the economy, even if it's sluggish, if it doesn't just fall off the cliff here, if there's some growth left, that investors are going to settle down, Maria, because even with slow growth, we got 11 times earnings with a dividend yield that's almost higher than the 10-year bond yield right now. And I think that greed is going to slowly set back in here, and maybe you're already seeing that with insider corporate buying, looking at these values, and even if there's risk, you just can't hardly pass this up. So I think if I was investors, they ought to start taking advantage a little bit at the margin if this thing settles down by edging back towards risk and taking advantage of these low prices on risk assets.
You know, we're mindful of the volatility we're seeing right now, but when you think about it, we are at the tail end of what has been a lost decade for investors. I mean, we have a 10-year chart of the S&P going back to 2000 when we, you know, at least in Dow terms, was the first time we hit 10,000, and that's essentially where we are right now. For the S&P, that number is about 1,100 or 1,200 or thereabouts. So if you're investing for the long term, you're going to find those things that are going to actually make you some money over the long term.
I agree, Bill, but, you know, we have been flat in the stock market for the last decade, but we've done a lot under the surface because even though the stock market's been flat, earnings have doubled since that time almost, and the competitive interest rate has fallen by 1/2 to 2/3. So we've really cheapened the level. You could buy stocks at, you know, 35 times earnings at the top of the market. You can now buy them at 11 times earnings. Right. The competitive interest rate was 7 to 8% at the top. It's now 2%. So we have made progress. Even if the price hasn't gone up, you've really created a much better entry point for investors today, and with the prospect of there being a much higher prospect of being more success, I think, for the future.
Jim Paulson, always good to see you. Thanks for your thoughts tonight. Appreciate it very much.
Thanks for having me.
And that's probably why dividends play such an important role these days, because you're then paid to wait while those stocks are growing, hopefully at some point.
And we keep hearing that that's a safe place to be in this environment. Up next,